Welcome to Quick Bite, your fast and friendly Florida insurance
Hello,
update.
hello, hello. This is Roshonda, agency owner of the Isom Insurance Group here in the Sunshine State of Florida, back again with another Quick Bite episode, your fast and informative insurance market update. Today is Wednesday, February the 25th, 2026, Hump Day. And today's quick bite is not about rate filings, not about tax debates, and not about citizens' takeouts. Today we are talking about fraud. As I mentioned last week, I introduced the fraud on Wednesday, and I believe going forward, I'm just going to introduce like fraud cases that have either like they're just happened or have happened in the past and kind of the outcome of those. Because I just feel like insurance companies get a bad rap as not wanting to pay claims, but that's really not the case. And it's just because they have to move cautiously because they've been bitten. And usually when it's a fraud, it's not just a couple dollars. It's usually big money. So we're talking about a $233 million fraud scheme that targeted some of the most vulnerable people in Florida. This case just resulted in federal prison sentences in February this month, 2026, and it is one of the largest Affordable Care Act enrollment schemes we have seen. And before we go any further, let me be very clear. This is not about the Affordable Care Act itself. This is about people who manipulated the system for personal profit. Big difference. So today we're going to break down what happened, how it worked, why it was so harmful, and what this means for consumers and the insurance industry. Let's get into it. This case involved two primary individuals, Corey Lloyd, a South Florida insurance broker, and Stephen Strong, a marketing company CEO. Together, they orchestrated what federal prosecutors described as a street marketing scam. And when I say marketing scam, I mean that literally. They hired marketers to approach homeless individuals and people in substance abuse recovery centers. Let that sink in for a moment. They targeted the most vulnerable populations. They offered small cash payments, sometimes $5 to $10, to get individuals to enroll in Affordable Care Act plans. But here is where it crossed the line. To qualify for government subsidies under the Affordable Care Act, an applicant must report income within certain ranges. If income is too low or too high, subsidy eligibility changes. So, what did these brokers allegedly do? They fabricated income levels, they used fake addresses, they created documentation to make individuals appear eligible for federal subsidies. The goal was not to help someone access health care, the goal was to create commissions. Insurance brokers receive commissions for enrolling individuals in qualified plans. That commission structure exists to compensate agents for their work. But in this case, enrollment became the product. Not coverage, not care, just volume. Prosecutors state that over 180 million in fraudulent federal subsidies were paid out. The total loss tied to the scheme reached approximately 233 million. And to make it worse, text messages presented in court showed the defendants joking about sending marketers into hurricane shelters to find more recruits. That is not just fraud, that is exploitation. In February 2026, both men were sentenced to 20 years in federal prison. 20 years. That is not a slap on the wrist. That is serious federal sentences. The federal government does not move lightly in these cases. When you see a 20-year sentence, it tells you the scale and severity were significant. Now, let's talk about why this is not just about a headline. Fraud like this damages trust. Trust is everything in insurance. When people hear insurance broker connected to 233 million in fraud, it affects the perception of the entire profession. And for ethical agents like me and many others across this state, that is frustrating. It is. Because the vast majority of agents operate ethically. But one high profile case creates a shadow beyond reputation. There is also financial impact. When 180 million in federal subsidies are fraudulently paid, that money does not vanish into thin air. Taxpayers absorb it. Government programs tighten oversight. Regulations increase. Compliance requirements expand. And that affects legitimate agents and legitimate clients. This is the uncomfortable question. How did something this large continue? Fraud schemes often exploit volume and automation. If thousands of enrollments are happening, patterns can be buried, especially if documentation appears complete at first glance. But eventually, red flags appear. Income inconsistencies, repeated addresses, enrollment spikes in certain zip codes. Data analytics is becoming more advanced. And when large scale anomalies appear, investigations follow. In this case, investigators piece together fabricated documentation, payment flows, and communication records. Eventually, the scheme unraveled. Let's not forget the individuals involved. Homeless individuals and people in recovery centers were paid small amounts to sign forms they likely did not fully understand. Some may not have realized they were being enrolled in plans. Some may have lost access to legitimate assistance. Some may have experienced confusion on billing notices tied to plans they never intended to maintain. That is the part that bothers me the most. Fraud is bad. Exploiting vulnerable populations is worse. Let's clarify something important. Commissions are not inherently unethical. Commissions compensate agents for advising, enrolling, servicing, and supporting clients. When done correctly, commission-based compensation aligns incentive with service. But when enrollment volume becomes the only focus without regard for eligibility or need, that is when things fall apart. In this case, enrollment numbers were allegedly inflated through fabricated information that crosses from compensation into criminal conduct. What this means for consumers. You might be wondering how this affects everyday Floridians. First, expect tighter enrollment verification process. Exactly. When fraudsters do certain things, now it makes it harder for legit people. Second, expect more documentation requirements. Third, expect closer oversight for broker activity. Fraud leads to friction. Friction affects everyone. That does not mean legitimate enrollment becomes impossible. It means scrutiny increases. Nationally, healthcare fraud costs the United States tens of billions annually. When you combine Medicare, Medicaid, ACA, subsidies, and private insurance fraud, the numbers are staggering. Every fraudulent dollar shifts cost somewhere else. It shifts into premiums, it shifts into taxes, it shifts into regulation. Fraud is not victimless. It has ripple effects. Let me say this clearly. This case does not represent the insurance industry. It represents individuals who choose greed over ethics. And the 20-year federal sentence sends a strong message. Fraud at that level will be prosecuted aggressively. And frankly, it should be. If your business model involves bribing people $5 outside a shelter to sign forms, you are not running a marketing strategy. You are running a countdown clock to federal prison. That is not sarcasm, that is reality. For agents, agents, this case reinforces the importance of accurate documentation, honest enrollment practices, clear communication, ethical marketing. Shortcuts do not stay hidden forever, and volume without integrity eventually collapses. For consumers, if someone approaches you with the promises of free money or offers to sign you up quickly without verifying income, that is a red flag. If someone asks you to use an address that is not yours, that is a red flag. If something feels rushed or transactional instead of consultative, pause. Insurance enrollment should involve clarity, not secrecy. The 233 million marketing ACA scam is one of the largest subsidies fraud cases tied to Florida in recent years. It targeted vulnerable populations, it exploited government programs, it generated massive illegal commissions, and it ended in 20-year federal prison sentences. The takeaway is not fear, the takeaway is awareness. Ethics matter, oversight matters, and trust in this industry depends on both. If today's quick bite helped you understand how large scale fraud impacts the insurance industry, now's a great time to stay informed and proactive. If you would like to review your current coverage or request a quote, you can visit our website at www.isominsurancegroup.com. Remember, it's right below me on the screen. Preparation always beats reaction. If you found this episode helpful, please like this video, share with your friends, and drop a comment below with any topics or ideas that you would like for me to address in any future videos. Please subscribe to the channel. When you subscribe, you get notifications of when a new video drops. Quick Bite episodes drop Monday, Wednesday, and Friday at 2 p.m. Eastern Time. This video is for educational purposes only and should not be taken as specific legal tax or insurance information. Please consult a licensed insurance professional about your unique situation. This is Roshonda with the Isom Insurance Group here in sunny Florida. Thank you for watching. I will see you next time. Stay safe out there. Bye.
Thank you for watching. Visit us at isominsurancegroup.com.